The biggest thing I wanted to talk about is bonds or fixed income. Fixed income has typically acted as one of the main portions of portfolios. Obviously, fixed income is generally seen as a more conservative investment, and essentially what a bond is, and bond and fixed income go interchangeable, is a bond is essentially a loan. Someone borrows money today with the promise of paying it back in the future. For that ability to borrow the money today, they're going to pay interest payments, which are also coupon payments in bond terms, back to the lender of the money over time with the promise of paying back the principal at the end. That's basically the general 101 of what a bond is. Because of that promissory note of how a bond operates, bonds are typically seen as much more safe and secure investments. And over time, they really actually have been pretty safe in terms of the returns that they've provided the investors. To kind of preface that into a little bit more high-level talk, I want to really kind of break down how a bond actually generates returns. The main return stream for a bond is actually the coupon payment or the interest payment that you're receiving from the borrower. And usually that comes in semi-annually, so 2 times a year. So generally when you're buying a bond, it's because you want that consistent, continual interest income coming in. So money coming into you, cash flow coming into you. What has really happened lately is that fixed income yields have gone down significantly as the Federal Reserve has cut interest rates. And that's a whole nother story and a whole nother video for another day. But essentially, bond yields are influenced by a number of things, but first and foremost is typically what the Fed does with interest rates. So as the Fed lowers interest rates, bond yields also decrease. What we're seeing today is so much less of a portion of the return has been from, not from income like historically, but has been from price return. And so to go back to my 101 of a bond, essentially how bond pricing and bond interest rates work is that as interest rates go down, bond prices go up. And as bond prices go down, interest rates go up. I know that that's contrary to some of the thinking, especially if you're really used to looking at stocks. But think about it like a dividend yield. As the stock price goes up, the dividend yield goes down. As the stock price goes down, the dividend yield goes up because it becomes more of a portion of the price of the actual stock. Really, the main point of this video is to just get the wheels spinning in your head to say, hey, if bond yields are at historic lows, which they are, there's negative yields across the whole globe, then what do I get from investing in bonds? Well, traditionally what bonds have acted as they've been negatively correlated to stocks or equities. And so what that does is it kind of gives you the free lunch of investing with diversification. So by buying a portion of your portfolio in stocks and a portion of your portfolio in bonds, historically, whenever that stocks have done well, bonds have been okay, and you've gotten a decent income from the interest payments. And when stocks have done poorly, bonds have actually been negatively correlated to stocks, and they have performed well because when stocks go down, typically investors flock to safe haven investments, which is typically something like bonds, especially US government bonds. But what that does is it drives the yields down and the prices up. So it's really a nice blend, and it's been historically great. And actually, even if you look at some different charts, the overall long-term corporate bond market has actually outperformed equity markets since the year 2000. So bonds can provide really crucial and essential returns to portfolios. The average 10-year treasury is a 4% yield, which probably isn't far off in terms of historical rates. All right, so if I take, similar to like a PE ratio for a stock, if I take the price, I'm going to say a bond price is usually at 100, and I divide it by $4, which is my earnings, I get a PE of around $25. That's not a PE similar exactly to equities, but you get the point that I pay 100 and I get $4 in terms of my yearly payment of interest, so 25 PE. Well, now interest rates on 10-year treasuries are below 2%. So if I take that 100 and then I divide it by my 2, roughly, to say 2% interest, then now my PE is at 50. Well, stocks like Google, stocks like Exxon, many other stocks don't even trade anywhere near a 50 PE ratio, which is pretty ludicrous. What I think and what I incorporate into my portfolio allocation is that, yeah, there's a lot less upside with bonds now. Unless rates go to zero, which is a whole nother story, but I don't see a whole lot of returns coming from these fixed income investments and securities, at least in the meantime. Essentially, if you give up that correlation benefit of saying, hey, when my stock portfolio does poorly, well, I'm going to have the bonds come in and kick in and help kind of offset some of that hurt by the kind of easy, steady nature of what bonds have been historically, well, then I'd see much less point in owning bonds. The other thing to really think about, and I know that this gets a little bit more high level, my background is in fixed income trading, so it's a little bit more analytical, and I want to keep this simple. But if you think about it from this stance, if I'm getting an income every year off of my bonds that I can then reinvest back into other securities or other bonds in order to kind of dampen that price volatility, what happens with fixed income is that I get that annual coupon payment or the semi-annual coupon payment, but essentially I get that money that I can then go reinvest into other securities. Well, if I don't have the same type of income that I historically have had, it's much lower now because interest rates are lower. Well, I've got less money to then go back and reinvest into other securities as time goes on and on. So essentially what that does is it makes bonds even more risky because you've got more interest rate risk embedded in the bonds, especially long duration or longer, further out maturity bonds. Again, do your own research. This isn't specific investment advice. This is solely for educational purposes. Drop a comment below. I'd love to answer any questions that you had. And if this video brought you, or if you think this would help someone else provide value, please share it and give me a like if this video was informative and helped you guys. I appreciate you tuning in. Thanks, guys. Have a great evening.